welcome. Thank you all for joining us. And in this session, we'll be discussing how the One Big Beautiful Bill Act affects Americans living abroad. So just to introduce our expert panelists, Thomas Carden is founder and international tax director at American International Tax Advisors, which provides US tax advice and services to Americans moving to or living in Asia, Australia, and Brazil. He is enrolled in practice before the Internal Revenue Service and has over 25 years of tax and financial industry experience. He has a bachelor's in global business management from the University of Phoenix and a Juris Science Master's in international tax and finance service law from Thomas Jefferson School of Law. He resides in Thailand. Tom Zachystal is Chief Investment Manager at International Asset Management. IAM, a US registered investment advisor specializing in financial planning and discretionary investment management for Americans living abroad. Tom has an MBA in global management from the Thunderbird University in Glendale, Arizona, and holds the Chartered Financial Analyst credential and is also a certified financial planner practitioner. Tom lives in the San Francisco area, having previously lived overseas in several different countries. He has been providing investment advisory service to American expats for over 20 years. If you'd like to schedule a consultation to discuss your personal US tax or financial planning or wealth management as an American living or planning to live abroad, head over to aitaxadvisors.com or IAMadvisors.com. Before we get started, please note that this webinar is for informational purposes only. It's not intended to offer advice or guidance on...
Let me go ahead and share my screen here so that you guys are able to see my slide presentation. Okay, now one thing I'm going to do on this particular one is this is going to be kind of a brief overview with it due to just limited time. We're going to do a series of seminars here over the next 6 months, helping you guys plan. This thing has just passed in the last couple of weeks, so we're trying to get you guys what information we can. There's a lot of things there's a lot of regulations and rules on how these are actually going to have to be done that has to be written. If any of these things in particular concern you, contact us directly with it, and we're glad to help you out and give you advice on what we're dealing with and what we know. And there's going to be some things that I'm not going to cover in here too much, especially on like rental property, because that's a separate transaction as far as the bill is concerned and not necessarily set up for expats. But we are going to do a series of seminars on that as well. So what I'm trying to do in this particular one is give you guys some stuff of what did pass and what didn't pass that'll help you out dramatically overall, because there was a lot of stuff that was talked about that actually didn't get involved in the bill. But these are the big things that actually affect, U.S. citizens living overseas. Okay. Now, the first and probably the most important one is a remittance tax and wise transfers. Okay. Now, this is a tax of 1% when you send money overseas from the U.S. Okay. Now, originally, this was not going to affect U.S. citizens and or green card holders at all. Okay. That sort of changed at the last minute with us. Okay. Now, the good news about this is you're probably not going to have to pay this. Okay. That 1% would be paid automatically by the sender, not the receiver. So if you are receiving money from overseas, this doesn't affect you whatsoever, but it would affect your sender to this. Now, what that means is if you're sending this incorrectly, you get taxed on 1% of this. Now, let me see, let me get back and forth with these things on this. Okay. The remittance tax is 1% on outbound money. Okay. But the reality of this is, at this particular point, by regulations and the law, it's meant to be the guys who go into a service like Western Union and pay, give some cash down or give a money order and then send the money out through there. Okay. This is meant for those guys who are hanging out in the U.S., working illegally or legally, and sending money through those services. If you are doing a bank-to-bank transfer, so you're going into your Bank of America account or wherever and sending money to yourself here or to particular anybody, or anybody sending it to you, if it's coming out of that bank account to another bank account, it's certainly not going to be taxed at that 1%. You don't lose anything if you move bank to bank. Now, on transfer services using like WISE, okay? Now, as regulations that should be written on this, if the money comes out of your bank account into WISE and then is transferred out of WISE to your account here in Thailand, to what you're using as a transfer service, it's effectively a secondary bank-to-bank, you should not be taxed at that 1% ratio to it. Now, how do you describe this? Regulations have not been written on this, and stuff tends to slip in on regulations. So keep up a track on that. And, and before you have to do one of those, you might want to call us with this and ask. I believe that actually starts in 2026 as well. So we've got until January to know what the regulations are going to do on this. But that does not affect you guys if you're using a bank-to-bank transfer. Now, secondarily to this was the revenge tax, okay, so-called revenge tax. Now, what that was meant to be was a tax penalty on foreign income coming from overseas sources on jurisdictions that were deemed to be punitive taxation towards U.S. Companies and U.S. shareholders with this. Now, what that meant was when you're trying to use a foreign tax credit, you could be subject to a penalty up to 30% of the income going overseas, or a lack of a foreign tax credit coming into the country. Okay. Now, supposedly as U.S. citizens, you were not going to be subject to that in the first place, but those entire issues over the revenge tax bill were scrapped at the last minute, largely because the OECD got rid of the global minimum tax standard for U.S. taxation to this. They exempted it and said, okay, U.S. income is not subject to global minimum tax, which therefore gives you guys a freedom of not having to worry about that tax. That was a bit of a sweat, but again, as U.S. citizens, you were not supposed to be subject to it, but it didn't even get passed at all, so we don't have to worry about that particular bill. So these were really the two things that a lot of people worried about who would have dramatic effects on your lifestyle, is losing 1% on every transaction you have, and or this potential global tax regime if you were living in a non-friendly country with us. That's the gist of those two things with it. So by and large, we're still actually pretty good for U.S. expats, of this. I'll give you guys a little bit of feedback and, some other items on this to give you some information about this. So, okay. Now, senior tax deduction highlights. Okay. Now, this is going to be a little bit wacky on this, and everybody's heard about this, but we're still not quite sure on the formulation on this thing. Now we like it. So, effectively what happens is Social Security now gives you an additional deduction of $6,000 per year. Okay, that $6,000 per year is for individual and $12,000 for marriage. Now, the math on how this is actually going to work out to this is not really clear. We haven't even found anybody who's written on the actual mechanics of this. We do know that $6,000 deduction will begin to phase out if individuals have $75,000 of income or $150,000 of couples with this. Now, mathematically, what the government is telling us is that 88% of people who receive Social Security benefits will not be taxed on their Social Security. Now, in addition to this, we've got a lot of Thai clients. It's our home base here, as everybody knows. If you're using the tax treaty on pension income or IRA or 401k income, and you only have that's free of tax by the tax treaty and Social Security, your tax on your Social Security also zeroes out. So it would actually be kind of a limited number of people here in Thailand, but in other countries, this can help dramatically eliminate your taxes. We don't have a lot of specifics on this. Again, we'll give you more updates as we go along with this. And from my understanding, again, this starts for the 2026 tax year. 2025 stays the same with this. So with current rules, this will all begin on January 1st, 2026. Okay. Now, foreign tax credit. Now, this is one of the wackier things they were working on. Potentially, they could limit the foreign tax credits using a revenge tax for countries that were punitively taxing U.S. companies with it. Now, that did not occur. So in the last passing of this, they removed Section 889, targeting unfair foreign laws. which means for effectiveness, the foreign tax credit does not change for you. This is a very good thing. Now, this is for sort of the opposite of the retirees that we just mentioned in the Social Security slide. The foreign tax credit, if you have overseas income and you're paying taxes in those countries on that income, you can use that as a credit against your U.S. tax liability. In fact, this is best if you have children here, because then you can get the additional child tax credit and get a refund for your child back. So this was actually a good thing that they removed Section 899 for everybody with it. There was a lot of hype and hysteria about them doing this because there was so many unknowns about when or who they would do that 30% tax against on the foreign income. But now that's all gone away, so you've got your street standard for foreign tax credit with it. Now, the foreign tax credits, though, the biggest issue of this is that while not directly altering the FTC amount, foreign tax credit amount, the law increases compliance burdens on expatriates, lowering reporting thresholds, and imposing heavier penalties for non-compliance, impacting the overall tax reporting requirements. What we don't know is the nuts and bolts on how this is going to affect. More than likely, the documentation we may have may be more substantial for this, and penalties for false filing on foreign tax credits may be more of this. We're going to keep everybody informed on what that's going to be, but you're going to have more documentation, we believe, for getting foreign tax credits with it. Currently, it's actually pretty loose, and you can use what's called accrual or cash. Cash means we paid that foreign tax in that particular year. Accrual means the liability was incurred for 2020, say 2025, but not paid until 2026. Because it was accrued and you had that liability, you're able to use that. This may change in this. No guarantees on this. Or again, it's one of those things we're going to have to follow up as the IRS issues rules and regulations on how that foreign tax credit is going to get affected. Keep up with this, guys, and we'll keep you up to date. Of course, if you're clients, we're going to talk to you about this each and every year when you come in with it. Okay, now, another big one affecting our expats overseas, although you retiree guys, some of you guys are extra vibrant, you might have this issue with it, is the changes to the child tax credit. Okay, now, if you're working overseas and you have income to this in certain levels, you can get what's called an additional child tax credit, up to $1,400 per child if you are within certain income bands to this. Now, one of the problems in the past with this was if you, as a U.S. citizen, and put your wife on your tax return, and she was not a U.S. citizen or resident alien with a green card, you had a problem that she had an item number, and you could not get the the child tax credit if you put her on your tax return with this. You could, in many cases, file head of household, but then you lose a $12,500 standard deduction. It was always an if and or buts on this thing. It was always in a perfect situation. Now, however, they've changed this by Congress to where only one parent requires okay, there we go. So now, again, this gives a lot more families an opportunity to get into the additional child tax credit. Now, we've got a lot of our client base is senior citizens, and again, you guys out there, well, if you got a Thai wife, you might actually have children. But if you know anybody who's a teacher out there, especially, these guys can get a tax check back, even if they have no U.S. sourced income whatsoever. So a lot of these people are filing with the foreign earned income exclusion. Instead of using the foreign tax credit and applying for this additional child tax credit, you really can make a big deal for these people with it. It's very nice to give a family here who's teaching, making $18,000, $19,000, $20,000 a year, $3,000 or $4,000 back because they've got their kids on and they meet all the requirements and stuff. It's one of the nicer things in the business is when you get to help these families out do this. But if you know anybody in that situation or you've got children here, make sure you talk to them about us because we can see if we can get you these credits as well. And again, your wife does not have to be a U.S. citizen now, and you can take advantage of the extended deduction as well as the additional child tax credits. So it's a big change for certain people. Okay, now this is the big one here for working individuals. Okay. Now I mention that because the foreign earned income exclusion has to be essentially earned income that you're doing some type of labor with. But the good news of this, and this is not purely part of that bill, but they've just announced this. So I try to put this in every time on this, and we'll probably do another seminar just updating the rules in the foreign earned income exclusion for you. But this year, if you've earned income overseas, do this. And we've got a lot of clients in Saudi Arabia and the Middle East as well. This is specific because they can't use the foreign tax credit. With it, you can exclude up to $130,000 US dollars each year in earned income. Again, some type of labor with this. Now, last year was $126,500. Now, here's the good news about this too. Say you are married as well, and now you have the extra $25,000 from standard deduction as well. Suddenly you have $155,000 if just one person has income with this. Now, if both you and your wife are working overseas, you're able to exclude up to $260,000 in a combined exclusion. Now, that means $130,000 maxes out per person. So if you're married and your wife makes $10,000 and you make $250,000, you still only get to exclude $130,000 per person. Now, and there's two different ways to do this. With it, you have to be able to be outside the country for 330 days or a bona fide residence with it. But again, if you are interested in this one, give us a call and contact us. Now, again, this isn't always the optimal way to do things with it. In fact, one of the things we do really specifically is we try to look at your way to get you optimize everything. So a lot of times, especially when you're overseas, that the foreign tax credit may be the optimal way to do this. And if you use that method and you pay more tax than you have in the U.S., you can actually use that excess credit when you move into a lower tax country. Now, if you're making more than $130,000 per person or more than $260,000 a couple, that gets really complex. You generally have to use both the combination of the foreign tax credit and the foreign earned income exclusion with it. Those returns are more complex, but yet they can massively minimize your taxation to this. You can't use it on both types of income with this, but it's possible to deal with. And it's also possible to do this if you are only in 1 year partially. We've lost a person in a good set of clients who's in Cambodia at this particular moment. Due to the government cutbacks, their contract ends here at the end of next month, so they're going to go back to the U.S. The question came in, can they use the foreign earned income exclusion for that 8-month period? Well, yes, because they were here 330 days in the last 12 months. So they get to use they get to use 2/3 of the foreign earned income exclusion for 2025. So about $85,000 is being able to be used as the foreign earned income exclusion and reduce their taxes in Cambodia. So there's a lot of complexities with this, but give us a call and definitely talk to us about this, because this is a way of maximizing your taxation, but it's not always the best way to do this. Okay, next slide, you. Okay. This is going to be the big one that's going to affect everybody who's living overseas. Okay. I'm sure we're all familiar with the joyous issues of the FBAR in general. Okay, now the FBAR and the 3524 forms are getting a whole lot more compliance with this and are going to get to be a whole lot stricter rules and foreign gift entries and what you have to put onto it. Now the FBAR is going to have extra income items put onto it, and the mandatory threshold gets to this. And extra income comes into what qualifies to be put on the FBAR. All these things are going to get to be stricter. And 3520 is going to get extra information on it as well. Now, what this means, is that these things are going to get more complex and more robust reporting on it, even though they're rather onerous as it is. Although there was a bit of good news that came up in, I believe it was June with it, but it was just recently. The IRS, at one point, if you were filing a 3520 late, they were doing an automatic $10,000 penalty even if no tax was due with it. And there's a lot of receiving gifts, or if you had a trust account overseas, now you can actually go to them and say, here's the reason why I was late for filing this. And they have the ability to waive that $10,000 penalty. Before, it was an almost automatic thing. It was actually one of the most onerous penalties in the IRS. We have not seen anybody get this waived yet, but because that was a very, very new ruling with it. But you want to make sure you get these things done on time. And the 5471, which is the controlled foreign corporation reporting, so if you've got more than 10% shares of a company overseas, that's going to be involved in this as well. In fact, we are very, very specifically going to do another controlled foreign corporation seminar here in a few weeks to a month as more information comes down to it. The bad news about that is for CFCs, the threshold for filing goes down, the threshold for reporting ownership goes down, and the potential penalties get even worse with it. Now, really, they now start at pretty much 10%. It used to be if you had 50%, based upon the end of the year, you didn't have to do that. But expect these three issues: your FBAR, your any types of gifts from people on overseas, and any trust reporting overseas being much more punitive with this, and the 5471. We're going to do seminars about each of these individually in the following weeks, so we'll keep you informed on this. Now, again, if you've got a specific question on this, right now I wouldn't panic and give us a call on this because we don't have a huge amount of information on the regulations that come up to it, but give us a call by starting about November 1st, and we'll have conversations with you what we know on. This should not, from what we've read, affect 2025's filings and this stuff. This is meant to be 2026 as well. So we've got time on the actual new reportings and stuff, theoretically. The regulations on this stuff as it comes out can always be a little bit wacky on how this comes into. So some of these things, they might start changing dates and stuff, but it should not be in effect. I try not to overwhelm you with information. There is a bunch of stuff on rental properties. Again, we're going to do a specific one on rental properties. But the reality of this bill is that at first it was terrifying expats overseas with it. It's not really going to be that bad for you. So we're good to go. Thank you, Hugo, for doing a gracious introduction.
Okay, so I guess it's my turn now. So I'm going to try to share my screen here. And hopefully you can see that slideshow. Hugo, can we see the slideshow? Yes, we can. Hugo's nodding. That's great. All right, so we went through the intro. I won't spend a lot of time on that, but basically we're an RIA firm, registered investment advisory in the U.S. We've been dealing with expats since 2002. 95% of our clients are Americans living abroad in about 35 countries on 6 continents. If anybody knows anyone in Antarctica who needs a financial advisor, we'll do them for free just so we can say we have somebody on every continent. So there isn't a lot in the big, beautiful tax bill that we could talk about from an investment perspective, but there have been a lot of other policies that have come out of the Trump administration lately having to do with tariffs and so on that do affect the investment climate. And so I'm going to talk about the bigger picture here a little bit. And let's start with this slide here. So obviously everybody is talking about tariffs, what they might mean, and nobody really knows what they're going to mean because nobody knows how the tariffs are going to end up. You know, there's a threat, there's a 10% base tariffs on every country in the world, even ones that they can't possibly import anything from the U.S., even countries that have penguins in them and so on. And then these tariffs, how will they end up? So, for example, right now there's a threat of 35% tariffs on Brazil, and so that's an issue. And Europe is negotiating. Some countries have already negotiated agreements, like Japan and the UK. So nobody knows how this is going to end up. But at the end of the day, these tariffs ultimately would have to be inflationary, and they would have to be a tax on American consumers, even if some of the tariffs are absorbed by other countries, and even if the U.S. realizes some more tax revenue for that, they're not going to be absorbed entirely by other countries, other companies in other countries. Some of it is going to fall back on the American consumer for sure. Also, Trump has this policy where he would like to see interest rates go down, and big debate now with the chief of the Fed about this, ongoing debate. So he would like to see lower rates and a weaker dollar. And in fact, we'll have a look at this a bit later. We've seen the dollar weakening quite a bit so far this year because a weaker dollar makes U.S. goods more competitive. That's the theory of it, right? And then the big, beautiful tax bill, well, eventually it's probably going to lead to a higher debt burden, which also tends to mean a weaker currency. the idea is that you spur the economy and it makes up for this extra spending that you're doing, or the taxes that you're cutting and so on. But probably this is going to lead to a higher debt burden down the road for the U.S. and a weaker currency, maybe. And then the other thing that the bill does is it can lower taxes for some businesses. In fact, it also keeps the tax rates, the Trump administration is keeping the tax rates the same, rather than the Democrats wanted to raise them back to what came before the other, not the big beautiful tax bill, but the one that came before. I forget what it's called, but anyway, so the taxes are staying at a relatively lower rate, I guess, which tends to be good for U.S. business, tends to be good for higher income people in the U.S. as well. So who benefits from all this? Well, it remains to be seen. As we know, we don't know what's going to happen, but if the tariffs work, that is to say, if the imports and exports from the U.S. become more balanced as a result of this, which is the idea, or if countries end up cutting checks essentially to the U.S. Because of the tariffs, then at least near term, that should be good for U.S. workers and the economy as companies move more of their business to the U.S. and so on. But longer term, probably what's going to happen is that other countries will have free trade agreements amongst themselves. Already you can see Canada and Europe, and Canada, Japan, Europe talking. So probably longer term, there's going to be more of that. There's going to be less U.S. influence in the world. And if the tariffs backfire, then really nobody wins with high tariffs. But probably the U.S. is going to lose the most because these other countries will do deals amongst themselves. And so that is probably the more likely scenario, at least in some cases. And so let's see what's been going on in investment markets so far. You would think with all these tariffs on other countries, their economies would be suffering and their stock markets would be suffering. But they're not, because the world seems to realize that this is going to be worse for the U.S. than it is for maybe other countries. And in fact, what we've seen year to date is the purple line is the S&P 500 index, the U.S. stock market. It was negative until mid-May, basically, and now it's up about 7%, which is not bad. But other markets have done much better. For example, you look at non-U.S. markets up 18%, emerging markets also up 18%. Gold has done really well. Bonds haven't done so well, but we've seen a rotation to non-U.S. investments. That has been one of the trends that we've been witnessing so far this year. And if you look at specific countries, you would think that maybe Germany and Europe and Mexico and Canada wouldn't be doing so well, at least on the stock market side, because of all these tariff threats. And yet, here we are, 7% for the S&P 500 down at the bottom there. Germany's up 33%, Mexico's up 26%. Canada's up 17%, the Eurozone up 26%, even China's up 27%, and their economy isn't doing very well right now at all. So we have seen this rotation, and this is also helped by a weakening U.S. dollar to some extent, but the dollar hasn't weakened that much. Even without the weakening in the currency, these markets would still be up far more than the U.S. market. And so let's have a look at what the dollar has been doing. And this is the dollar versus euro, British pound, yen, a few other currencies. And essentially, you can see the trend. The trend up to the right means a weakening dollar. It's been weakening against most major currencies. It's weakened probably the most against the euro out of the big currencies, down 13% on the year so far. And I'm getting a lot of questions these days about, well, what does this mean? Is this going to continue? Is it going to reverse? So one thing to bear in mind is that currencies are not like the stock market. They are mean reverting, at least the major currencies are. You don't get a major currency like the dollar weakening or strengthening forever, versus something like the euro, for example, because eventually what happens is the products become uncompetitive in one part of the world, there's a recession, and then that currency falls, whereas if it's been strengthening before. And so there's kind of a balancing act, but this balancing act can occur over a very long period of time sometimes. So if we look at longer term, what's been going on with these currencies, there's 4 of them compared to the dollar here. So we can just look at the top one, the euro versus the US dollar. And so up and to the right means that the euro is strengthening, down and to the right means the dollar is strengthening. And what you can see is that sort of after the dot-com bust in 2001, basically we got into good economic times for the most part, and the euro strengthened. In fact, it went up at one point, it was 150 to the dollar. And then since about 2008, since the financial crisis, and that's another thing that generally happens is when there's some kind of a big crisis, the dollar tends to strengthen because investors run to the safest investment out there, which is U.S. Treasury bonds. But if these policies continue, that may no longer be the safest investment. So that'll be interesting too, because there could be some disruptions in the U.S. Treasury market eventually. But anyway, since 2008, the dollar has been broadly strengthening, not just against the euro, but if you look at the trend in all of these, I mean, the British pound one's a bit special because of Brexit there, but basically the dollar has been strengthening for 15 years maybe versus most major currencies until you get right to the very end, which is 2025, and that's what we were looking at on the other screen there, where it's kind of reversed course. So the point of this is that when you're looking at the euro, for example, you're really in the middle of this range. And so which way is it going to go? I don't know. But there is certainly room for the dollar to weaken further. And so if that's a concern for you, if you're spending money in euros, for example, you might want to convert some of your cash if you have your savings in dollars right now, just so that you have a bit of spending money at what could be a not bad exchange rate, because certainly the policies right now out of the Trump administration are weaker dollar policies. So then the other question I get these days is, how do I get my money outside the U.S.? And, that depends on what you're actually trying to accomplish. First of all, it's very difficult for U.S. citizens to have non-U.S. brokerage accounts. And so probably if you're a U.S. citizen living abroad, you're better off keeping your investments in U.S. brokerage accounts. For one thing, you get the 1099 forms. You don't have to watch out. You don't have to worry about PFIC issues. PFIC are a tax reporting issue if you're buying non-U.S. Mutual funds and ETFs. You have to worry about that. So it's probably best to keep your investments in U.S. brokerage accounts. And then the question is, who can you deal with? That's another question we can help you with, because there aren't that many brokerage firms that deal with expats anymore. But if you, for your money kept in local currency, there what we recommend is that's what your safe money should be. That's what your spending money should be. You can put it in things like term deposits or savings accounts, or if there's some kind of a CD equivalent or something like that. Those are not PFICs. And so that's what you might want to have your euros or your pounds in, and then your investments are on the U.S. side. And if your investments are in a retirement account, you can't move them anyway. They have to be U.S. accounts. So that's what we're talking about there. And another way to move money outside the U.S. is to buy non-U.S. real estate. And, if you have a little bit more money and can afford to do that, then rental property or a second property, that can be a nice investment in local currency. There's, if it's a property that isn't rented out, there's very little U.S. tax reporting to be done on that. So that's also a nice way to get some money out if you can afford to do that. And so the other way to get money out is not really to move the account, but to move the investments. And so we use 2 custodians. We use Charles Schwab and we use Interactive Brokers to hold our clients' accounts. With Interactive Brokers, we can have multi-currency accounts. We can buy on exchanges around the world. If you live in Europe, we can buy on the European exchanges. So it's a nice setup that way. So that's one way to get it outside the U.S. in a sense. But you don't necessarily have to buy on foreign exchanges. You can buy, for example, example, exchange-traded funds in the U.S. that are geared towards Europe or Asia. There's a Hong Kong fund, there's a Korea fund, there's a Thailand fund. There's obviously Euro and Euro funds and so on. And as long as these funds are not hedged back to the U.S. dollar, where they take out the currency effects, as long as they're unhedged, you're still getting the currency exposure, even though the fund itself is reported in U.S. dollars. Another way of saying that is if the investment value within the fund doesn't change, but the local currency strengthens, then you'll see the value of that fund go up in U.S. dollars. So you get that currency leverage. That's probably the easiest way. The other way is to buy ADRs, American Depository Receipts, which are basically shares of non-U.S. firms that trade on U.S. exchanges. That's another way to get that foreign exposure. And then, so this is this is the slide I wanted to put up. There you go. It's all on there. So there's also multi-currency accounts. There's other asset classes you can invest in, like gold. We mentioned real estate, other commodities, and so on. You can also invest in foreign currency, either directly by buying the currency or what are called currency shares, which are basically exchange-traded funds that allow you to invest in other currencies. That's another way. So there you go. And then just to sort of wrap up my side of this, what are some of the other expat issues that we see come up? Well, if you're moving abroad, thinking about it, or maybe already there, one question that comes up for everybody is, will your bank or brokerage firm even continue to deal with you? Because many U.S., especially the brokerage firms, will not deal with you once you move overseas. And if they will deal with you, do they require a U.S. address? And the same, if you have an advised account, then will your advisor continue to deal with you? Because sometimes you're dealing with an advisor and his compliance department or her compliance department won't let them deal with you. Sometimes your advisor will say, well, if you keep a U.S. address on it, then I can still deal with you. What that means is he's not telling his compliance department that you live overseas, right? And so that's not the best situation. You want to be able to put that foreign address on your account if you're living there permanently. And that's where companies like Charles Schwab and Interactive Brokers are great partners for that kind of thing in most places. The other thing that comes up is there are different tax regimes that maybe we're not used to in the U.S. Something like wealth tax, for example, in Spain, wealth tax is a big issue. There are inheritance taxes. In the U.S., we have an estate tax, but the limit is quite high. Most people don't pay it, right? In other places, they have an inheritance tax, which is a tax on the person who inherits, actually. And in other places, they have different tiered regimes. For example, in Spain, they have 2 tiers of taxation, depending on whether it's savings, what they call savings, or whether it's what they call income. Another thing to watch out for is property sales and purchases. A lot of people move overseas and then they sell their house in the U.S. Well, if you sell that house after you've become a tax resident elsewhere, you need to think about what the gains from that sale mean for local taxation. Because in the U.S., we get the capital gains tax exemption. Most places don't have that. And so a lot of times it's better to sell your U.S. property before you become a tax resident somewhere else. Currency transfer is another thing that comes up. Not very efficient to go bank to bank, but there's companies like Wise out there. Interactive Brokers also has a great exchange rate. Other currency transfer businesses are out there as well, like OFX and Money Corp and so on, that you can use. Estate planning, trusts are not recognized in a lot of places. Sometimes they lead to higher taxation, even if it's something like a family trust that we would consider a pass-through entity in the U.S. Inheritance tax laws, healthcare, power of attorneys, and so on, things to think about. And then there's a lot of little issues like two-factor authentication. Once you give up your U.S. phone number, for example, there's an app called Tossable Digits that lets you keep your phone number for SMS purposes. You can use that for two-factor. So all of these things we can help you with. We don't help you with directly all of them, but these are issues that you need to think about if you're planning on moving overseas. And so with that, I'll end my part of this, and I think we're going to go to Q&A.
Thanks very much, Tom and Thomas, for those great presentations. To our attendees, to our audience, if you have any questions regarding any of the topics Thomas and Tom have covered today, drop those into the Q&A. There's a little box at the foot of the screen. And I know a few of you have dropped questions in there, and Asa from AI Tax Advisors has been kindly answering those. But if you have any more questions, this is the time. Drop them in, and our panelists will answer them. I know Thomas is.
Can I do a quick question, Tom? With it, I mean, are we looking? 55 now, and I remember in the late 70s, early 80s, where commodity things like ADM, where the stocks went up, was it back when we had regular tariffs for the Reagan administration, even into the beginning of our administration? Are we really kind of mirroring that period right now from about 76 to 82, do you think? Or, yeah.
It might be. It's been a while since, and it could be actual commodities or companies that are related to commodities like ADM you mentioned, for example. And yeah, I think in times like these, in uncertain times, people tend to run to harder assets, right? For example, gold has done really well lately. So a lot of people running to gold. Silver kind of tracks gold. It's just more volatile. And then it depends on what it is as well. So for example, copper has a use. Copper prices actually haven't gone up that much, but there's a lot of copper that is mined in places like Chile and Peru, and so some of the companies there are doing quite well, and so yeah, I think there is sort of a trend towards diversification in that area.
Thanks a lot.
So I don't think we have any more questions. So just to say thank you very much to our experts, Thomas and Tom, for taking the time to present to us today. If you'd like to schedule a consultation to discuss your personal financial planning, investments, or tax situation as an American abroad, head over to aitaxadvisors.com or IAMadvisors.com. We'll email you a link of the recording of this session over the next few days. And in the meantime, thank you all very much for joining us, and have a pleasant rest of your day.
Thank you, everyone.
Thanks.
Mm-hmm.